Hey, and welcome to this video about why you should not have money in a savings account. In this video, I will show you why it's bad to have money in savings and where you should put your money instead to get a better return. So if you're ready, let's get started. So, why is it bad to have a savings account? Well, let's talk about how banks operate first. So if you are looking to open a savings account, you go into a bank and you put your deposit down and you get savings then from the interest that you make on your savings. Then, consequently, if you are a borrower, you go into a bank, you look to make a loan, and then you pay an interest rate for that loan that you get. At the moment, banking interest rates are almost at 0%. So if you have a savings account, you're not making much interest on that. Banks almost have it at zero because they want to make borrowing more affordable. And why is it banks want to make borrowing more affordable? By making borrowing more affordable, banks can increase inflation. So what is inflation? Inflation is measured by the CPI, which is the Consumer Price Index. This is a basket of all the goods and services within an economy, and usually an economy wants this to grow by 2% every year. This needs to grow because it promotes growth within the economy. If the inflation target is more than 2%, that can lead to hyperinflation, which leads to the currency being devalued. Any less inflation than 2% then, an economy can risk stagnation or potentially deflation. Deflation is when an economy stops growing and actually reverses in growth, which was seen in Japan in the last 25 years. So, global savings interest rates around the world are currently at less than 1%, and then inflation rates are 2% in developed economies. So say for example, you have £100 and you put it into a savings account this year. Next year, you will get £101 returned from that savings. Say a basket of goods then costs you £100 this year. Next year, with inflation running at 2%, that basket of goods will cost you £102. So you will not be able to afford that same basket of goods that you could buy this year, next year, because your savings account will not run at the same rate as inflation does. So where should you put your money then to be able to beat inflation year on year? The answer is in a balanced portfolio. For those of you who don't have a stocks and shares account set up, my card is popping up here for a stocks and shares video that you can look at to be able to set up your own portfolio. So, what should you have in this portfolio? It should be balanced with a lot of different asset classes in it. That would include bonds, stocks, gold, and other things that could go in there to be able to diversify your risk. Stock markets on average have returned 10% since they started. That is 8% over the inflation rate. So if you have this in a tax efficient wrapper, you should on average be beating inflation by 8% every year. If you don't have it in a tax efficient wrapper, you still have a lot of headroom on average to be beating inflation, as opposed to being in a savings account where you are definitely going to lose out every year. You should invest and keep invested for the long term, so over a 5 to 10 year time frame, to be able to let the returns average out. So that is pretty much it on why you should not put your money into a savings account. If you have any questions at all, please leave a comment below. I'd be happy to answer any questions any of you have. If you like this video, please subscribe to my channel. Just click on the bottom right hand corner of your screen to do that. Thanks for watching.
Hey, thanks for watching. Subscribe to my channel now to see more content like this in the future. See you soon.